We open up the show today with some stunning news from regional banks. Not really, but Moody's came out and downgraded a number of regional banks, citing concerns that I think we all know about, and markets are reacting today. Just early market trading here. We've got the Dow off more than 300 points, S&P off about 40, and the NASDAQ off close to 165. So, Mark, let's start right there because apparently it's making news. What did Moody's do? Was it this morning, overnight, when it comes to the nation's regional banks? Why are they so mean?
The Moody's is a rating agency. They assess the creditworthiness of bonds or the likelihood of, say, equities to pay dividends, stuff like that.
We've been hearing a lot about credit rating agencies recently, right? We had Fitch, who downgraded the United States debt just last week. So, one of the big credit reporting agencies, and they
reasonably
monitor all
highly
sorts of stuff.
regarded.
Yep.
They took it on the nose after the financial crisis for their failure, they and other rating agencies.
Pretty much every
for their
rating
failure
agency.
to assess risks of these structured instruments that owned complicated combinations of mortgages.
Yep.
So they went through a purging and a crisis of the industry went through a crisis of faith in them and so forth. But to your point, this is sort of a late reaction to something markets figured out months ago. The regional bank index, which has an investable ETF, if you're feeling saucy in an investment sense, that's down 5% in the past 12 months and about 15% year to date. So there is nothing, as you led with, Mike, new, I don't think, for equity investors here. But to answer your question, they downgraded about a dozen regional banks, pointing out funding challenges, which means nobody wants to put money there. Depositors are skittish, understandably. Mm-hmm. And balance sheet, I think, challenges as well. Their bread and butter is lending to investors or to businesses that want to buy commercial real estate.
Right.
So that side of their balance sheet's taken a hit as well. So at least a double whammy, maybe a triple whammy if you count the larger environment and structural headwinds, stuff like that.
So I don't think we should just pave over the situation. I think we all know that regional banks are unhealthy. I want to get into why. In terms of the specific banks that were cut here, we had ratings cuts at M&T Bank Corp, Webster Financial, BOK Financial, Old National Bank Corp, Pinnacle Financial Partners, and Fulton Financial. Both Northern Trust and Cullen Frost Bankers, they're under review for downgrades. They also looked at several others and gave negative outlook for PNC Financial, Capital One, Citizens Financial, Fifth Third Bancorp, Regions Financial, Ally Financial, Bank OZK, and Huntington Bank shares, many of which are having a negative reaction today. So I want to kind of take a step back, though, and recap what's happening in this regional bank area, because it does not seem to be the same issue or issues that may or may not be plaguing larger banks, but specifically a regional bank problem. One, they cite that capital requirements are different between smaller banks and larger banks. And so that's one of the things here, is that just by the nature of the fact that they are smaller banks, they probably don't have as attractive of balance sheets as large banks. Is that kind of one of your reads as well?
I think that's fair, yeah.
Furthermore, the funding costs for operating these banks, i.e. what they have to pay on deposits in order to attract and retain them, is quite a bit higher and is now eroding profitability. Again, I think this isn't a surprise to anybody, but if you are getting that offer from your bank for a 5% CD, guess what? It's going to erode that bank's profitability because that's what they feel they have to offer to keep you and your money in the door. Furthermore, these banks are faced with a somewhat difficult dilemma. I think all said and done, they would like to be loaning money out. That's, how banks make money. They take in deposits, pay you an interest rate, and then loan that money out at a higher rate. And realistically, they could probably do that right now. There are plenty of potential borrowers out there that might need to refinance a commercial real estate loan, for example. But at the same time, these banks are now scratching their head and saying, hey, is that actually a space that we should be lending in at all right now, right? Should we be refinancing this 1,500 unit apartment complex that we initially loaned money out for a decade ago? Yeah, we could get 10% interest on it, but what is that thing actually worth, and can they afford to make those payments? And I'm being nice with the apartments. Let's start getting into shopping malls and office space, and that might be an entirely different story. So again, I think that's the position that these banks are in, is not necessarily an imminent demise, and I don't think anything about Moody's downgrading. Moody's downgrading any of these is stating that, but it's pointing to the fact that, hey, we might not be having a run on these banks at this stage, but they are not out of the woods on all of this, and it's going to be a challenging environment for them to make a strong profit over the next few years. Anything that I'm missing on the regional banks right now?
I don't think so. There's still, I think, a lack, I don't want to say a lack of transparency, but...
Sounds like you do.
Yeah, I guess I did. I mean, we don't know how much trouble, so to speak, certain banks will probably fail, particularly if, or be absorbed in an orderly way into a larger organization bought by a bigger bank. As this cycle progresses, rates will likely stay higher than they've been over the past, say, 20 years for an extended period, even if inflation cooperates. So there's probably more pain to come. What frustrates me when I read stories like this is I don't know what the call to action, so to speak, is. If you're an individual investor, you're reasonably well diversified. If you own, say, stocks through an index fund, you may have a tiny bit of exposure to something like this, but probably not much. And there could be a bounce back in conditions that causes these share prices to recover. So even if you could, you might not want to sell out. So it's not clear to me what an individual investor would do, or an individual like us would do with information like this. It's sort of,
well, let's take it a step further.
The obvious.
Are there probably pension funds out there or endowment funds at universities that have strict rules around the credit ratings that must be on the bond portfolio in their
But I don't know why they'd own this stuff to begin with. A pension or an endowment will hire a consultant who in turn hires an active manager. So you hire Loomis Sales here in town or somebody like that to run your money. And they
should be forward-thinking enough to know that they
studiously avoid defaults. I mean, the whole point of hiring an active credit manager is to mitigate defaults. So I doubt very much that they would be, that the stakes would be very high for them at this stage.
I agree that this is, in every way, information that we already had. And if it were new information, I think they would be having more than a 1% market sell-off. But in any case, it can't be good news for any of the
The regional
banks.
bank index that I pointed out earlier, which is available in ETF form, so it's like an investable thing, as crazy as that sounds to me personally, is down another couple percent today last time I looked. It's quite volatile, so the number might be different now. So apparently it wasn't all priced in, Mike.
So when we think about the practical implications here. Actually, forget about the practical implications for investors. There is this assumption in the banking industry that I think needs to be called into question. And you hear it talked about on quarterly earnings calls, which is deposits are sticky. Accounts are sticky. Bank of America says this all the time, right? We don't have to pay higher interest rates because our deposits are sticky.
Not indefinitely sticky in the short run, yeah.
I'm calling that into question. Here's my conclusion.
Yeah, that's right.
Accounts are sticky. Funds are not. This has been like one of the guiding philosophies of these banks for a long time is, hey, if we do everything else right, then we'll be able to hang on to deposits here and keep cash in these accounts, because think about how big of a pain it is to move your money out of Bank of America where you do all your bill payments, do your everything. And I think that what is actually the case is that I'll never close my Bank of America account, but if I can go get higher deposits elsewhere, technology these days allows me to electronically transfer those funds anywhere in the world within 24 hours. And so I'll keep my Bank of America or my M&T Bank or whatever bank you want to mention on this list, that account open, because I need to do things like pay bills and have everything set up the way I do. But I'm not going to keep more money than I have there. And I'm not sure, that's the one piece that I'm not sure banks have really caught up to, is the pace at which you can move money around and the pace at which consumers are clearly willing to do so in order to chase yields.
Yeah, you might be right. Behavior can change, especially when people are motivated by a shock like this.
And that might not be the case for my parents' generation. Right, like I meet people in their 60s and 70s all the time, and I mention the idea of an online bank with a high yield money market, and they immediately shut me down. Like, I'm not going online and transferring a bunch of my money to some bank that I can never walk in the door. But I know nobody my age that doesn't takes issue with that. And so there's definitely this generational difference, and I do wonder how that plays out in this banking industry, because I no longer think that necessity of having the local branch that you can walk into and look somebody in the eye is what today's, at least younger generation of depositors care about.
Agreed.
And
Yeah,
that could be a serious
I have no
problem
deep
for these
insight other
banks.
than to say.
And I think it leads us to the same point, which is we have way too many banks in this country. There's going to be a bunch more consolidation, it would be my guess.